Good evening and welcome to this webinar series with myself, Charlie Burton. This month's webinar is on the probabilities for the rest of 2024. So it's going to be fairly punchy and quite fast in relative terms, so which is quite nice. So last month's webinar was quite a long one. This one, which is going to be, I'm literally going to be throwing data at you, just slide after slide of data. So just a little bit of, before we go into any of that, the usual risk disclaimers need to be presented. The disclaimer: the material provided is for information purposes only and should not be considered as investment advice. The views, information and opinions expressed in the text belong solely to the author, not to the organisation, committee or any other group or individual or company. Right, okay. Let's get into the overview of this month's webinar. So we're going to be covering off what 2023 told us about this year, 2024. The importance of breadth thrusts. What are those all about, and what's their relevance here? Why 1961, 98, 2013, and 2019 could determine what happens this year, and the probabilities around the US presidential election, along with seasonal patterns going into the end of the year. So that's what we're going to be going through just over this next probably 20 minutes or so. It's going to be quite quick. I do have something fairly interesting to some of you. That's going to be fairly interesting to some of you. I've teamed up with Tickmill, of course, on this, and we've come up with a great idea whereby for some traders, if you would like free access to my trading community, I have an online trading community, doesn't matter where you're based in the world, then I will share that with you at the end of this sort of 20-25 minutes. So that's where you can get free access to my community, and we'll go through that at the end of this. But anyway, coming back to the presentation first of all, I'm a bull overall. So I'm presenting to you the bullish case for 2024. Now, you've got to bear in mind, the stock market, as you know, is already up a reasonable amount. The S&P's up 15% so far this year. So, but I've had these stats for a long time, and so we've been working with these stats since the earlier part of this year. So what I wanted to do is share these stats with you and how things could work out going into the end of the year, especially with the US presidential election. Okay, so I'm just going to be throwing analysis research after analysis research at you. First one here is looking at, this one's from Carson Research, and this one is looking at last year. So last year, 2023, the S&P did 24% return. Historically, what does it mean? So a 20% plus gain. So it did a 24% return last year. Whenever we've seen historically years where there's been a 20+% return in the S&P, more often than not, 80% of the time, the following year has been higher. So 2023, there's a great, coming into 2024, there's, based on the history going back to 1950, there's greater likelihood, 80% historically, likelihood that the market ends up again having a positive year. Now, a couple of caveats here. Well, not really caveats, but this column was talking about, well, did the S&P do a better return than what it did in this column over here? And most of the time it didn't. It still had a follow-through positive return 80% of the time, but most of the time it couldn't replicate or beat 45%. It didn't do 45% the following year, it did 26. So Well, we've got a question mark here coming into 2024, of course, because we're not seeing it out yet. And as we already know, 2024 is already up 15% for the S&P. So next slide here. What does 1961, all of these years, 1987, 2019 and 1998, what do all these years have in common with this year? Well, historically, they all had a Q1, first quarter, gains of greater than 10%, much like this year did. So the S&P is up 15% at the moment. At the end of the Q1, it was up just over 10%. So historically, again, the final 9 months of the year tends to have positive gains going in by the end of the year. So it doesn't always that the stock market is going to be higher than where it was at that end of that Q1, but certainly it favors positive returns still going into the year end. What I'm seeing and have seen in the last, especially in the last month, is a lot of people getting quite bearish towards the stock market. And that's fair enough. The stock, the stock market has to correct at some point. It lasted a correction of 6.5% in April. And what we tend to find is the stocks go up, people tend to get more bearish because they're trying naturally to pick a top. And of course, many of us are aware that when we look at the US indices, there's a bit of a breadth breakdown. And what we mean by that, if you take the S&P 500 stocks, the stock index, for example, the index has been making new highs, but the number of stocks within that index that are making new highs is diminishing. So it's those relatively fewer stocks, the big Nvidias and your Microsofts and the likes, which are driving that stock index, whereas there's a lot of individual stocks within it which are not making new highs. So that's what we call a breadth, weakening breadth. However, weakening breadth doesn't guarantee that the stock market is going to roll over. So there's been a lot of chatter about that lately. It's not to say that it couldn't do a correction. We've had a great run again, but it's not a guarantee. There was a lot of that talk in 2023, and yet 2023 was a great year. So anyway, coming back to this year, when the Q1 is greater than 10%, the odds favor 90% probability that the stock market still ends up positive by the end of the year. So let's move over now to this breadth thrust. And so this is, the breadth thrust was created by a chap called Marty Zweig. This is courtesy of Ned Davis Research. And Marty Zweig isn't alive anymore, but he was a stock market analyst and a stock investor himself. And he created this breadth thrust. And so what is a breadth thrust? Well, we can see all of these signals of when there's been these green diamonds of when the stock markets have had breadth thrusts historically. And the 12-month return, if we look at the 12-month return here, has 100% of the time, whenever we've seen a Marty Zweig breadth thrust, 12 months later, there has been stocks have been higher with an average gain of 23%. Okay. So what is a Marty Zweig breadth thrust? Well, it's when the 10-day exponential moving average of the New York Stock Exchange advances divided by the advances plus declines moves from 0.4 on this calculation to above 0.61 within 10 days. Don't worry too much about but that's the calculation. So, and when that happens, it creates a breadth thrust. And historically, whenever we've had a breadth thrust, 12 months later, there's been positive returns. So if I go to the next slide here, this gives us all the way back to 1945 when we have had these breadth thrusts. And the interesting thing was that we actually had two last year in 2023. One was in March, Now, we've obviously gone past the 12-month part from March of last year, so that's done. And we've had that positive return. We also had one in November here. So we're not 12 months on yet. And I've already put it on. We're 26% up since November of last year. So we're already 26% up. That doesn't mean to say we can't go higher. Look, in 2009, we had a Brett thrust and we ended up 46% higher, 44% higher here, 32% here. So admittedly, we've already had quite a run. But nevertheless, what that's telling us is that 12 months on from November of last year, we should be higher. Obviously, we already are higher. We're 26%. It'll be interesting to see where we are. But all of these things favor the stock market's not crashing into the end of this year. It's not to say that we couldn't have some pullbacks, but they shouldn't be crashing down and, and going into a bear market. And we're going to present some information on that as well. So all of this at the moment still favors, a positive year for this year. And so, again, another one. The first 50 days of the year, what does it mean for the rest of the year? Well, 96% of the time, if the first 50 days return is greater than 5% on the S&P, then again, the end of the year has an average return, and that's giving all of these, including 1987 when it was actually a negative year, it gives an average return of 12%. So again, the stats favor stock market closing out the end of the year positive, not negative. Now, this chart here I wanted to share because this is an interesting one. What I want you to look at is the S&P return columns here. So we've got the negative years, but I want you to have a look at the positive years here. So when the histogram is positive, so when all of these positive histograms are positive years for the S&P going back to 1980. All right. Now, even within those positive years, you look at the gold diamonds here. That shows us what the maximum pullback was during that year. So as you can see, even in some really stellar years, like in 1980, it actually had a 17% pullback within the year. And so we can pick off a number of very positive years here, 16% pullback, and so on and so forth. Most positive years tend to have pullbacks of up to 10%. But there are these years, like this one here. This was in, 2003? Not surprising there, coming off the bear market. Massive up year. And yet its pullback during the year was, maximum drawdown pullback was 14%. So what I'm trying to show you here is that even in these positive years, stocks do have some half-decent pullbacks. So within all of that, so just painting a picture here for you again, that even, and we've already had a 6.5% pullback for the S&P so far this year into April, but it's not to say that we couldn't have a larger pullback at some point, and yet we still end out the year positive. So that's my point there. Now, here's one again for the bears. So for the bears, there's been a lot of talk about when the Fed first cut interest rates, whenever that may be. Okay, and there's a fair bit of chat around, well, when the Fed cut interest rates is because the the economy is going into recession, and therefore stocks are going to decline. Well, actually, there are, plenty of occasions when after the first Fed cut, there is no recession. And the green line on this chart shows those instances where, well, there was no recession. Fed cut rates, there was no recession, and stock markets continued going higher. And what's interesting on this chart, if we take the zero line here, is 3 months later. So 3 months later, or here, that we can see that stocks are higher. And even when stocks go into a bear market, I've got some other data in a second, after the first Fed cut, stocks still went higher first. So even if we are going to go into a bear market at some point. And here's another one. I don't know where, I can't remember where I got this one from, but there have been 9 Fed cuts, rate cuts, starting a rate cut cycle that started, since 1985, where a Fed cut has started a rate cut cycle. So not just a standalone cut, there's been more. And if we look at the S&P performance during these periods, then the US equity market tends to rise in the subsequent 3 months following a rate cut cycle. So again, it's just another warning to you that, well, don't get too bearish, because I know that some people are a bit bearish on, well, if we get a rate cut, then stocks are going to start rolling over. Well, the first 3 months at least, that's if we don't go into recession. If we don't go into recession, we carry on going higher. But even if we go into recession, well, stocks tend to benefit from that initial rate cut. And in fact, the average S&P gain during those 3 months following the initial Fed rate cut is 5.1%, which is significantly above the normal 3-month S&P return, which is in the 2 to 2.5% range. So again, just a little bit of a heads up for anyone who is bearish on things like a rate cut, or when and even the fact that we've got some breadth divergences, whatever it might be. If you're bearish, that's fine, but don't get too bearish just yet, because 2024 statistically, based on historicals, still looks like it should be a positive year. Now here's one for the bears, and again, for those of you who are looking for that big trade, a bit like 2022 when we're in a bear market, this is interesting here from Bank of America. And so what they're saying is that 81% of losses happen during the actual recession and not in the 6 months prior. So that's a fascinating one, because a lot of traders feel like they need to try and catch the top, long before a recession happens. But 81% of the losses in a bear market happen once the economy's actually entered recession. What I'm essentially saying is here, there's plenty of time. You don't have to catch the top. You can let the market roll over, and once it goes into a proper rollover, there's still plenty of time to short the market if that sort of thing was to happen. So statistically, there's plenty of meat on the bone, even once the recession's started. Okay, another one here. Make sure I've not... Yeah, okay. So let's now move over. So this is from Bank of America, again, from their equity quant strategy team. And again, this is now talking about election years. So again, for this year, it looks pretty positive, statistically speaking. So the S&P has had positive returns 83% of the time in election years. And it gives us the returns. The irony is we've had that big negative return in 2008 for obvious reasons during the financial crisis. So it's not 100% of the time, but again, the probabilities lie with across all of these stats that I'm presenting here today, they still lie with the stock market closing out the year positively. So again, more research here. Now this is an interesting one. So when the S&P has strong rest of the year returns in a presidential election year, when the index had a a positive return in the first 100 trading days. So it's just another different presentation of what I've just said. So historically, presidential election years tend to be good for stocks, not 100% of the time, but 80% of the time. And again, if we also have a positive return in that first 100 trading days, which brings us back to the earlier slide where I said, well, look, in the first 50 days of this year, in 2024, we were greater than 5% up in the S&P. Well, that tells us that we should continue to have a positive return for the rest of the year, into the end of the year. So again, it's just another variation here. Presidential election year plus after the first 100 trading days, stocks are positive at that point. Well, with a 93% probability, like we've had this year, then historically 93% of the time stocks have closed positively. So again, I'm presenting the bullish case for the markets. You may have a different view, but there's lots of stats here. So let's have a look at the cycles here for this year. So, and I'm really punching through these slides here. I appreciate that tonight, but it's quite a nice, easy flowing presentation here tonight. Last month it was full on. There was a lot to go through. Plus, we have to make sure that we're done before the top of the hour. So, and one thing, I know people are still coming in. I've got something to show you at the end of this presentation. In conjunction with Tickmill, we are making my trading community available for free to certain traders around the world. So I'll talk about that at the end. Anyway, so another stat here, or say a stat, this is historically, this is the seasonal pattern that on average that we've seen from 1950 to current. So this is an average of what the S&P has done during an election year over the last, 74 years. So some weakness, and chop earlier in the year, which we didn't really have too much of that early, but we did have a pullback in April. So it's not meant to be exact. Every year is going to be slightly different, but this is the general sort of template. So then we historically, across all of the election years within that 74-year period, tend to have a summer rally, taking us into a peak in August or September, and then a pullback through September and into October time ahead of the presidential election. And then a rally, like a Santa Claus rally, taking us into the end of the year. So that's the general pattern here, the seasonal pattern over the last 74 years when there has been election years. And it sort of makes sense. So the markets are fickle things. And at the moment, they've not been concentrating on the upcoming election too much. But of course, as we start getting into the thick end of the summer, Johan, as we start getting into the thick end of the summer, the markets are going to start looking out to that November election as things start heating up towards that. And, the markets don't like uncertainty. So it wouldn't be surprising to see some form of pullback in that sort of September, October period. It's not a guarantee. This is an average over those 74 years. I'm sure some years it didn't do it. But if we did see a pullback during that period, then the probabilities historically suggest that once we get past the election, that there should be some form of then rally going into the end of the year. Now, here's this next slide might fit really quite nicely with this pattern, because last year in 2023, some of you will remember that The stock market, we topped out in August and pulled back, August, September, and pulled back into October. And so this shows us that when January to July is greater than 10%, well, last year we were fabulously higher. I think we were up about 19% into July. And then if August and September is negative, and this is all going back to 1950, then the odds of an October, or historically what happens is October to December, that final quarter is positive. Every single instance between 1950, when this has happened, so when the first half of the year basically has been greater than 10%, much like exactly what happened last year, and then you see an August, September, which is negative, then the final quarter should end up positive, as we can see in all of these instances here historically. So, okay, and then that happened again last year in 2023. So that gets a tick because we had that mighty rally in the last quarter last year. So let me just take the screen back. So if we were to see the stock market top out in, let's say, August or so, and do a bit of a pullback, which it could do this year in this election year, then those stats could come back into play again for 2024. If we had a negative August, September, and going into October, then historically it favors an October to December rally. Okay, and that sits quite nicely with the historical chart here. Okay, right. Those are all of my stats. I said we'll probably have this done in 25 minutes. So to summarize, the stats favor a positive return by the end of this year. For those looking for another bear market, we rarely see a bear market just 2 years after the end of the last one. The end of the last bear market was in 2022. It's such a rarity that you will ever see another bear market happen so soon. So for those of you who are looking for a bear market, well, you've got to be a little bit careful that it's probably a little bit early at the moment for another major bear market. When the Fed cuts rates, it doesn't mean necessarily that stocks are going to fall. Now, if the economy starts to enter a recession, then yes, they will. And if it does enter a recession at some point, 80% of the fall in stocks happens once the economy is in recession. So you don't have to race into it, you don't have to try and pick the top at all. But for the long term, as I always say, it pays to be cautiously optimistic. Stocks, as we know, over the long term, spend more of their time going up than down. And when they are pulling back, it's usually it's a good opportunity to look for levels where you might want to be accumulating. So there you go. So there's a load of stats I've thrown at you, I know, in the space of 25 minutes, no, half an hour here tonight. But hopefully it's given you some food for thought, that whatever way I slice it, there's the historicals favor a positive year, especially with this being an election year. Okay. So what I'm going to do now is, obviously we can have a Q&A. We don't have to stop yet. We rarely do. Normally we go on for about 2 hours, but we can't tonight. So I'll take any questions you like on anything. But what I will do, because we've only just set this up, literally, we set this up today. And, pretty much. Let's have a look here. See if I can. So in conjunction with Tickmill, what we're doing is anyone who opens, and this is international, so this is outside of the UK, outside of the UK. Let me just double check if it's outside of Europe as well. Non-EU, sorry, anyone who's in the EU or UK, I don't think this can apply to. But nevertheless, if you come to tickmill.com/LP/Charlie-Burton, I'll just take that link and I'll pop it into the box here. So let's just do that into the chat box. So, for those of you who are international, all you have to do is open an account with Tickmill. You can have a look for all the information there, and we will then give you access to my trading community, which gives you all of my strategies, but also access to my trading room where I'm with my traders every day of the week, 5 days of the week, doing training sessions and trading sessions 5 days of the week. So, there you go. All you need to do is take that link and open an account. Obviously, there's some caveats. I think the minimum is $5,000 to open. Of course, Tickmill, it costs £123 a month to be a member of my community. So in order to essentially pay for that, Tickmill need people to open up an account of a minimum of $5,000. And I think they need to do, 4 lots a month. So not a lot, but yeah. There you go. Little Brucey bonus at the end of today's session. Right. Any questions on anything I've covered here tonight or anything else? Because we've gone through that really nice and in a nice, fast, succinct session manner here this evening as we've gone through all of those stats, but hopefully it's been of use. But I'll just see if we get any questions come through. Could be on any topic, trading wise, or no. I can see there's plenty of people in. These a bit fewer than usual. It's about 70 people in at the moment. So, but it's a bit less than usual. Maybe it's because of the European Football Championships, Johan. But yes, the people are less chatty. Yes, you're right. Yeah, let's bring up the charts. Okay, so Bitcoin, and the question is, any Tesla and Bitcoin targets for this year? Yeah, tonight was, I was throwing a lot of stats at you quite quickly. I appreciate that. Is this recorded, Mohammed? Yes, it is. This is being recorded. You will be able to get the recording from Tickmill. Where was I? Tesla and Bitcoin. Okay, I see the stock markets are down, actually. They're selling off a little bit here, the NASDAQ and the S&P. What's interesting, before I come on to those, what's interesting with the S&P selling off here today and the NASDAQ selling off a lot more is, so that's a lovely bar. It's like a key reversal bar as we're looking at it at the moment. But what's interesting is actually the Dow Jones itself is having an up day. So that sort of smells to me of probably a bit of sector rotation going on. The NASDAQ's off a bit. So tech stocks, some of those tech stocks are being sold, but we've got Dow component stocks which are being bought. So it's not universal is what I'm saying here today from what I'm seeing here. And obviously we still have 2.5 hours until the market close. Anyway, I digress. Bitcoin, let's go to that one first of all. Bitcoin, as you know, is a lot of the time influenced by the stock market. If we're in a risk-off environment, then Bitcoin can come off. But realistically, I'm going to come over to a daily chart here of Bitcoin. I've got all sorts of channels on here, old historic channels and all sorts, which I probably could take off at some point. But you're asking me, what's the question again? Yeah, targets for this year as far as Bitcoin. Overall, I would quite like to see Bitcoin get into the 90,000s to 100,000. That's what I would like to see at some point, maybe later this year or whatever. So Bitcoin broke to new highs, new historic highs, of course, this year. And overall, at the moment, looking at this weekly time frame, it's just consolidating. Yeah, it's pulling back today and whatever, and this week. But overall, the main point is Bitcoin is in a major bull market at the moment, and it's just consolidating. And that's what it does. So overall, I'm looking for higher levels for Bitcoin. But I think the thing with Bitcoin is you have to be careful. Some traders obviously trade it with leverage, which is can be dangerous. I'm of the attitude of just speculating in it with money you can afford to speculate with, and that's what I do with it. And it's just sits there on the side, and I accumulate as we go forward. Actually every week is what I do with that, with speculative capital. Moving over to Tesla. Yeah, Tesla is an interesting chart. So if I come to Tesla here, if I come to my weekly chart here of Tesla, I think this is quite an interesting chart because of this trend line, this declining trend line here. So it's been capping prices, as we can see, during this move since it made those highs in late 21. But when we get multiple tests of a trend line, I'm usually then looking for price to come back up and test it again at some point. So for me, I would like to see Bitcoin get back to that trend line, which is up comfortably above $200. So that's what I would like to see Bitcoin do over, this is a weekly chart. So over that sort of medium term, over the next 2 or 3 months or so, is what it would be on my wish list. Yes. Okay. Yeah, that's Tesla. Yeah, I've already covered off Bitcoin. Yeah. Hopefully, did I say Tesla when I was still looking at Bitcoin? Sorry, right. But yeah, I've covered off Bitcoin, and now I've just covered off Tesla. Sorry, I'm whizzing around. Right. Okay. Let's go back here because there's a lot of questions coming through. Yes. No, Vaughan, hold on a second, make sure. Yeah, Vaughan said, do you consider yourself more of a swing trader these days, Charlie, or a position trader? No more day trading. Yeah, I don't day trade anymore, Vaughan. It would be a very rare thing. It's not that I don't enter positions intraday using intraday charts, but I don't day trade, no. I just got to a point several years ago where I needed more time to be able to walk out of my office for a couple of hours or even a half a day or whatever. And when you're doing more day trading, if you go and have a day off, you've missed potentially a load of trades, yeah? And so, whereas when you're positional swing trading, it doesn't really make much difference. So, yeah, lifestyle changed and I needed more time to be able to do other things. And so, yeah, I don't day trade anymore. What do you think about long term on silver? Yeah, silver. I'm a long term bull on silver. If I go to the monthly chart here of silver, these are the historical highs from back in 2011. So, and what I think is interesting with silver, look, this is the monthly chart. So we've got these lows that occurred, multiple lows in 2011 and 12, and all through there this horizontal level became a key level all the way through, and then we've just broken out of that level in recent months. Obviously we've broken out of this trend line as well. So what with those breakouts here, breakouts above these highs as well, this is I see overall for silver, I see it as highly bullish. So I've owned physical silver since back in 2018. but and I still own that silver. But yeah, I do. Technically, this is highly bullish in the bigger picture. What goes on the day to day, is day to day. But even actually, if I do go to the daily chart, it looks pretty good at the moment. What's just happened is silver's come up, it's pulled back into prior highs here, 50-day moving average as well, and is rotating away from that as we speak. But I'm a bull anyway, so yeah, a long-term bull there for silver. Which tools or websites can be used to study historical trends and news? Oh God, that's such an over. I'd almost need to do a whole webinar on that, Sammy. So I'll have to have a think about that and maybe do a webinar on that, because that's not something I can off the cuff say. Oh yeah, so I'd need to do a webinar on that as far as studying historical trends and all of that and news. So yeah. When you trade stocks like Tesla, do you take into consideration news developments or only on a technical analysis? Johan, I don't personally. I just got asked about Tesla. I don't trade it. I don't trade actually individual stocks personally. I trade stock indexes and I trade currencies, and I will trade some of the commodities such as gold and silver at times as well. So I don't trade them. But you're asking me about that. Should you take into consideration news developments? Yes, I think you should. You should be aware if you're going to be trading a stock, obviously when the next earnings announcement's out, but also you need to be aware when other earnings announcements are out with other stocks within its particular sector group. I think you need to have taken a lot of information. You don't have to. You can just trade technically, but if it was me, I would want to be taking that into consideration as well, Johan. Yeah. I'm conscious of time here. Ronerwa, found you on YouTube in February and literally watched all of your YouTube videos. Well done to you. That's good. From your first upload, you elevated my trading business. Okay. And I appreciate your professional advices. That's very kind of you. And I apologize for not being able to pronounce your name. Will gold reach 23,000? Ooh. Well, let's go to gold, because it's at 2,000 at the moment. That's quite a bold call, Anthony. So I that's beyond me. But while we've got gold up, one thing with, again, coming out to the bigger picture, monthly chart, we've got a big technical analysis, cup and handle in play here. We've broken that cup and handle. If we take the lows of the cup to across the highs of the cup, and you take that as a projection, that's what you do in technical analysis, and you apply that to the high, then it gives a projection up around about 2,700, 800 or so. But 23,000, I'll leave that to someone else, because that's, completely different. In terms of gold, what do you think? There is a lot of geopolitical tension and the Fed. Well, what's been going on this year with gold is there's been a lot of central bank globally buying of gold. So that's what's been, helping and being supportive of gold. I think a lot of central banks have realized they should have more of it. And that theme has continued throughout this year and right into now. So yeah. I think we're in a major bull market for gold. I was trading it in the early 2000s, and that bull market ran for the best part of the decade. And I don't see any major long-term euphoria in gold. Like back in 2011, I was talking to some traders. I'll tell you a story here. And I was doing a webinar, much like tonight. And I was talking to some traders. And you imagine, gold's been on this long-term tear. Let me just put this into replay mode and just put it there. It was about here. And it's been this huge bull market. all of those, for all of those years. So traders became accustomed to gold going up and thought that gold was going to go to $5,000 at that time. And it was after this red bar, this sell-off bar, which was like a key reversal type bar in gold, and those other things. And the thing was, what had been going on with gold is here in the UK, we had all these gold kiosks opening up in high streets, selling, buying gold for cash and all of this stuff. The euphoria was just ridiculous. And to top it off, I was doing this webinar, and I was saying in this webinar why I thought that gold had probably topped for the foreseeable future. And the abuse that I got on the back of it saying, no, Charlie, you're wrong. Gold's going to go to $5,000 and all that. And I said, look, the very fact that you're all disagreeing and thinking that gold's going to continue going up, even though I've presented all this information to you, it cements my view. So I went out and sold some more. and yeah, so gold ended up coming, and let me just get rid of that. As you can see, went into a bear market itself, so essentially for quite a bear run, or whatever you want to call it, for quite some time. But I think we're in a significant bull market. This is my view. This is not the view of anyone else. This is just my views. Take them for what you will. But I do think that we're still in a strong bull market. There will be pullbacks, of course, within this. I would love, within this overall run that gold's in at the moment, I would love to see it get up to that 2,700, 2,800 level before we see the next, larger correction. There will be small corrections when we look at the daily charts, a bit like what's been going on. But in the big picture, that's what I would like to see from that technical analysis projection there. I can see I've got, just so you know, there's 23 messages lined up for me, and I know that I have to get this webinar stopped in about the next 7 minutes. So apologies if I don't get to all your questions. Come onto my YouTube channel and just fire some questions on there, and I'll always see those and can always come back to you. I'm trying to work my way through. So I've covered off a bit on gold, so I won't do anything on gold. Michael, if dollar strength continues and dollar yen continues going up, can euro dollar and dollar pound dollar still go up? Yeah. So okay. So yeah, it's we're in an interesting point here with regards to the likes of the pound dollar and the euro dollar. Pound sold off a bit today after the Bank of England. If I put this onto a weekly chart, it shows us where that's a bit better, where the pound is. And so if the dollar strength continues, the question is, well, if dollar strength continues, then the pound dollar will go down. But I think you mean if dollar strength overall, maybe against the yen, as you're saying. I've looked historically at when stock markets fall, because usually when stock markets fall, the dollar gains. But not always. There are historically periods where stock markets fall, but the dollar falls as well. So I can certainly answer that. But yeah, I mean, if the dollar's rising, then of course the euro dollar will go down and the pound dollar will go down. But so it's one to watch out for. If the stock market had a larger fall, then normally that favors the dollar, actually. My opinion on the euro dollar, Mohammed, overall, the euro dollar this year's into 2023 has, been choppy, but the lows of 2022 are still firmly in. That was a major level when the euro dollar came down there. it peaked here in 2023 at 112. The range for 2023 was something like 880 pips. The average yearly range is about 1,500 pips. So it was nearly half its average annual range there last year. So far this year, what's the range for the euro? About 440 pips so far. So whatever happens, we should see a reasonable expansion in its range this year. So coming back to your question, what's my opinion? Well, at the moment, the euro's just fallen away here, and we've got these political tensions, what with the French elections coming up, which has really dragged the euro down over this last couple of weeks. So my overall opinion would have been upside, because I'd have been looking at all of this, and when we get multiple touches of a level, this one broke through and then came back, and over here again, normally price will then come back up for it. And I taught that pattern several months ago on one of these webinars. So I would still be looking for that. However, the euro has got to get through these French elections. So let's see what they do first of all. Certainly there's some fears around that at the moment and the political consequences there. Look, just so you know, there's 24 unread messages I can see here. I'm never going to get through them. I do apologize, because I've literally got just over a minute or so, because it's not fair. Tickmill said that they've got another webinar, so they need the software. Do I think the Bitcoin could retrace to 50,000 in the short term? Yeah, of course. It's a volatile market. Of course it could do. When you backtest your strategy, how many years do you backtest, and how large a sample size trade data do you backtest? Depending on when you say how many years, depending on the time frame of what you're backtesting. So if you're backtesting a daily time frame, preferably sort of 5 years plus. But again, it depends on how many tests I've got. So I want to see, in excess of 100 historical tests, in excess of that. The more the better. So 100, 200, 300, the more the better. So it depends. If you're back testing an intraday strategy, you might only need to go back a year or two. So it does depend. And I'm going to have to leave it on that. I'm so sorry that we can't cover off more of these questions tonight, but we will be back next month in July 18th, Thursday the 18th of July, we'll be back. So apologies to all of the questions that and comments that are there this evening. I'm so sorry, but unfortunately it's a short and sweet one tonight. I know normally we go on for a lot longer, but do check out the offer there as well. If you fancy joining me in my community and you can ask me all these questions, all you got to do is open an account with Tickmill if you haven't already. Providing you're outside the UK, all of that stuff is in there. So it's tickmill.com/LP/Charlie-Burton. And check it out. And if not, I will see you either, like someone's mentioned, on my YouTube channel at some point. I'm in there twice a week doing videos, and or back here on the 18th of July in 1 month's time.